Thank you for joining me on Morning Markets. We've got a lot to get you caught up on. We already talked about the micro stories, the Shopify, the big earnings on the TSX. Broadly, though, there are a bunch of things that are going on. We're seeing weaker equity markets at the same time that we are seeing pretty sharp sell-off on the bond market across the curve, the 10-year yield up 10 basis points, and then you also have the long end extending, now yielding the highest level since October of last year. We've still got John Zechner and Chris Kerlow joining me on the desk. John, how concerned should we be about this sharp repricing in the bond market?
Amber, I think it's a major issue in here. And when you look at the last time the bond yields in the U.S. traded, about 420, this was last October at the lows in the stock market. So something that needs to be paid attention to, certainly as an alternative to the equity market, and maybe a pinch on valuations overall. And the fact, and the reason is because I think obviously the downgrade of the U.S. debt means they have to get more funding. And if you saw it last week, they had came out that I think they upped how much they're going to have to raise the Treasury from $700 billion to over $1 trillion. That's a big supply. And the old supply and demand, I think that's why the Treasuries are under pressure right now. But that's a problem for the stock market overall that's been running pretty hard on the view that, rates are going to be cut into next year.
Could this be the source of a 10% correction, you think?
We've been pretty cautious lately. I've been selling into this strength we've seen recently, and I'm less confident going forward. But my problem is right now, Amber, is I'm not buying into this. We're going to hit the soft landing. I still think we're going to be in a recession. I think when you look at the lessons of the 1970s, central banks realized they can't start easing too early. So the market's belief that they're going to be cutting rates into next year may be a little bit misguided because I think they would reaccelerate inflation at that point. So, I think there's more headwinds ahead, and the stock markets have been sort of almost priced for perfection recently, particularly in the technology sector, which is why you're seeing some of the sell-offs a little more dramatically if the earnings aren't a big beat.
What do you think, Chris? Are you soft landing camp, or perhaps a recession could be a little bit more severe?
We're more in the soft landing camp. Like John, we've been taking some profits here, not only just because of the Fitch downgrade. That didn't really come as a huge surprise. They put them on warning back in May. We saw the same thing play out 11 years ago or 12 years ago in June of that year, and it tended to be a pretty good buying opportunity. We've been adding to cash. We fortuitously took some profits from Uber and a couple stocks early this week, and parking that in cash, but which now pays 5%, waiting for kind of that opportunity. But it's not because of this. It's more, at the start of this week, the VIX was trading at 13. You're looking at AAII bears at the lowest level since June of 2021, and all of this rally on really multiple expansion. That kind of sets up for a potential 10% correction where we would, at that point, be deploying some of this dry powder.
The VIX, the volatility index, is up again. To your point, it's now at 17, the highest that it's been in 2 months, a far cry from, what we would call a crisis, but it's definitely moving up there. There was a tweet storm or an essay, I don't know what you call it these days, on Twitter or X or whatever it's called, by Bill Ackman, who was shorting the 30-year, saying it could go all the way up to 5.5%. At that point, that seems like a very difficult environment for stocks to continue to outperform.
Particularly those long duration stocks like technology. You saw that spike yesterday. Shopify down 2% today. It's down 7.5% yesterday. That's a large pullback in market cap. And then, you combine that with the U.S., it comes from the U.S. debt ceiling, a political posturing tool, and just building this debt. Debt to GDP has gone from 3% to 6%. It's really not a very rosy environment for that U.S. dollar or U.S. economy.
John, are you raising cash as well?
We had already raised cash, Amber, and I'm sort of looking for more of an opportunity, at a point to come back. Chris's point was good as well. I think the sentiment measures were, really extended, which was another consideration. Bringing up the Bill Ackman point on the bonds, let's put it in perspective. I think, Bill Ackman's a big hedge fund manager. I think these guys tend to talk their own book a little bit. So, I don't know what they're achieving with shorting treasuries at 425 or something like that. I think ultimately we have have not repealed the laws of economics. You got a highly levered economy, and consumers and investors that have been used to a decade of zero or very low interest rates, and you had the most dramatic increase in rates we've basically ever seen on a percentage basis in the past 18 months. This will slow the economy down. Just because it hasn't happened yet doesn't mean it won't happen. I remember going through these same arguments back in 2007, 2008, why it was taking so long. There was just too much stimulus in the system already, between the pandemic spending, fiscal deficit spending in the U.S. in particular, and obviously all the the pandemic-related stimulus in there and the zero interest rate. There was lots of money out there, and that's just taking a little bit of time to sort of get out of the system. When it does, when people start to roll over debts at these higher rates, the economy is going to slow down. I just don't see it how it cannot happen.
Okay, so this could put tech in the crosshairs, but I wonder what it will do to the industrials, because I'm looking at SNC-Lavalin up 6%, TFI, the trucker, hitting new record highs. This is a sector that has perked up recently. It has benefited from the rotation away from tech. But John, if you're worried about a recession, are you interested in any of these names that are really economic touch points?
Well, the nice thing about those cyclicals that you mentioned, and yes, I am looking at them because the valuations were already low. That's not where the valuations were extending. I don't expect a deep recession, when we get it. I think we'll have a couple of quarters of negative growth. So absolutely, I'm looking, at the consumer discretionary sector and certainly at the industrials, because the other thing is you got a big stimulus spending on infrastructure. The Biden program in the U.S. is large on that as well, and you've seen that. Why you saw good results out of the engineering companies like SNC-Lavalin as well. Plus, that was a bit of a restructuring story. But I like markets like this where you've got the earnings coming out, you're creating opportunities, and we can sort of, pick up, scavenge around and sort of see where we think people have overreacted on the downside, and we'll start to pick away at some of those names.
Are you scavenging around in industrials, Chris?
Yeah, we like industrials. It's a kind of buyer beware environment. Inventories are still really high. The Chinese restart's been a little bit lackluster. But to John's point, the IRA in the United States and some of the fiscal stimulus programs here in Canada are super supportive for that cohort. And looking at the latest inflation report out of Canada, it was non-residential structures that provided one of the bigger boosts to the inflation number, which is a sign that, the manufacturing and those industrial companies are having that confidence to go out and start building and buying again.
All right.